Hey folks, the average Canadian family now pays more taxes than basic necessities. The federal government announced that CMHC is going to increase amortizations to 30 years on first-time buyers purchasing new construction. And new CMHC data tracks new homes built in the first half of the year and compares them to last year. And the coalition against new home taxes has made a pledge to the federal government. All this and the city's new parking ticket increases on this episode of the podcast. I'm Vince Gaetano. Thanks for tuning in. I want to thank all the viewers and listeners of Spotify, Apple Podcasts, and the YouTube channel. Thanks for tuning in. So let's get right into it. So, first thing, the average Canadian family, according to the Fraser Institute, which is basically a public policy think tank. They've been around for about 50 years. They come up and determine how public policy is working. They've pointed out that the amount of taxes that a Canadian household pays has now exceeded the cost of basic necessities. So let's break this down. In 2023, the Canadian average family earns about $109,235, and 43% of this amount is attributed to a form of tax. And they track all taxes. They track income taxes, payroll and health taxes, liquor taxes, sales taxes, property taxes, profit taxes, which is capital gains, any excise taxes, fuel motor vehicle licensing taxes, carbon tax, natural resource tax, import duties, and any other tax associated for families. So that tax represents 43% of an average family's income, and basic necessities are now 35.6%. So that includes shelter, food, and clothing. They've been tracking this since 1961, and they claim that the amount of taxes has just gone up by an inflationary amount of a couple thousand since they've been tracking this now, which, inflation's impacted both incomes and taxes. So I don't think that's a really good tool. But the reality is that we pay more in taxes in Canada than the basic necessities. Folks, we need to get value for our tax dollar. And I think everybody's feeling that we're not getting true value on this amount. So if you do go to the Fraser Institute, the report is on their website. You could pull it off, you could dissect it, track it down, but this isn't a good sign. We need less taxes. We need to get more value for our taxes. And there's a lot of people feeling just unappreciative of the value we're getting for our tax dollars. So we'll keep an eye on any new taxes that are going to be imposed, but the reality is this is not a good sign of our current economy and how people are feeling about where their money's going when you factor in cost of living and all that. Second thing I want to talk about is the Minister of Finance and the Prime Minister have been all over the news preaching about this new change to CMHC's amortization. The CMHC amortization maximum was 25 years, and they're now extending it for first-time buyers purchasing new homes to 30 years. And they're claiming this to make things more affordable. But really, are they more affordable? The reality is this is not an affordability measure, folks. This is a cash flow improvement measure. And there's a big difference between the two. And I'm just going to point out an example. Okay, now I'm going to use a $500,000 purchase. And I know that's not reasonable, but we're talking about the country, so let's use a $500,000 example just to put things into perspective. If somebody buys with 5% down, which is $25,000, they're going to get a mortgage of $575 plus the CMHC premium that gets added to the mortgage. And when you buy with 5% down, that premium is 4% of the mortgage borrowed. So that's $19,000. And that's a default premium. That default premium means that if your mortgage or that borrower's mortgage goes south, the bank gets bailed out by the government for that default. It's not default for the client. It's default for the lending institution that's lending beyond the Bank Act's maximum 80%. So anything that's borrowed beyond the 80% loan to value threshold needs high ratio insurance. That's where CMHC, Sagen, and Canada Guarantee, the three national lenders, national insurers that can insure this mortgage, that's where they come in. So now you're borrowing about $494,000. So now at 5% interest rate, let's assume you're paying 5% interest. The payment difference between 25 years and 30 years is about $236 on this amount. So on a 25-year amortization, you'd be paying about $2,873. And on a 30-year amortization, you save a few bucks and you're paying $2,636 bucks a month. Over the course of the 25 years, you will be making total payments of $861,938. Okay, so you're paying close to $400,000, like $370,000 in interest over the 25-year period at 5%, assuming you have the same rate throughout the 25 years. By stretching out the amortization to 30 years, you will be paying a total of $949,000 plus. That's $87,000 more over the course of that extra 5 years. So is it affordable? Like, this is a finance minister of a country who's going out telling people that this makes housing more affordable. It's not fucking affordable, folks. You're paying $87,000 more in interest because you're stretching out this amortization. When you stretch things out, you pay interest for a longer period of time. Okay? It's not affordable. Okay? Maybe they're younger and they have more time to continue paying, but don't mislead folks and make them think this is affordable. So, folks, we got to make these politicians more accountable because they're providing information that's not accurate and they're misleading folks. And this is not a good policy as far as I'm concerned. In 2012, the government pulled back amortizations. We were as much as 40 years at one point. They pulled back the 35 and the 30 years on insured mortgages back to 25 because they wanted people to be fiscally responsible and not stretch out the amount of debt. They wanted people to pay down debt because it was getting out of hand. So, I'm not sure that people who subscribe to this really understand what they're getting themselves into, and it's important that they do. Now, it only applies to new construction, so this is a very small sliver of folks that would take advantage of this. I think CMHC claimed it represents about 6% of the marketplace, so I don't even know if that's accurate or not, but it's not a significant amount of people. Now, another CMHC stat that came out recently, and that is new data came out on the first half of the year's new construction, new building starts, new home starts, okay? Now, the stat came out really positive. They're suggesting that year over year from 2023 to 2024, we saw a 7% increase in new housing starts, okay? Now, okay, that sounds pretty good. But if you take out Ontario and BC, those new housing starts for the rest of the country is up 40%. Follow me for a sec here. The problem is BC and Ontario account for 53.1% of all starts in 2024. And in 2023, they represented 64.3% of all building starts in the first half of the year. BC and Ontario are down 11.7% combined. Okay? There was only 110,500 starts in 2024, just under that number by a few units. So we are in crisis mode. There is no way we're going to hit the targets that the federal government has set to build 4 million homes or whatever the amount is by 2031. It's not happening, folks. Nothing's being built. It's absolutely crazy to think that these folks are on pace to meet the demands that we need to accommodate the newcomers coming to the country, folks that need homes, and the basically homeless crisis that we're experiencing in the country. Like, this is just not going to happen. And these stats are staggering because I think we're going to build less homes in 2025. We'll see how the second half of the year shakes up, but I'm telling you, the construction sector is laying off a lot of folks and they're not necessarily working. So I'm just letting you know, it's only going to get worse. Now, there's a new group. Maybe they've been around for a while, but it's a group called the Coalition Against New Home Taxes. They go by the by Can't. Okay, they have a website called can'twin.ca. It's a group of builders that are trying to come together to come up with some solutions on how they could deal with this housing crisis. And they are pledging to the government that they will reduce the cost of new homes on a dollar for dollar basis with every tax that is eliminated from all the charges the various levels of government impose. Now, this group claims that a home in Toronto, new construction taxes amount to $241,000 per unit. Okay? Roughly 30% of the cost of a new home is taxes. Now, what they do illustrate on their website is which level of government imposes the majority of the taxes. Now, what's interesting about this $241,000 figure in taxes is that 15 years ago, in 2009, the tax was only $36,000 combined. So that's an increase of 569%. Okay? These governments have gotten drunk on all these development charges and input taxes into the cost of new homes. They're basically pounding the shit out of everybody who wants to buy new homes. Now, where does the money go? Here's the breakdown according to can'twin.ca website. Okay? The federal government imposes $31,000 in taxes. Okay? That's 12.8% of this $241,000 figure. The province charges $65,000, which is 27% of the overall cost of input taxes. And then our lovely government in the city, these councillors, these left-wing lunatics that just love pet projects, have increased the taxes to $145,000 per unit, which represents 60.2% of the $241,000 per unit in the city of Toronto. The city imposes 60% of these development charges. Folks, this is insanity, okay? They have basically turned new construction into a cash cow. And now that nobody's building as much as they used to, there's no cash. And guess what? They've had to increase property taxes. They've had to, cut fundings for various projects. But what they don't do is get rid of these pet projects, these bike lanes. These bike lanes are all over the city. I was just driving down Dufferin today. They're now painting a whole lane red. at Dufferin and Lawrence. I think that's going to be a dedicated bus lane, I believe. Okay, so we're going to be down to a crawl on Dufferin Street very, very soon. This is starting to get really concerning, okay? And we have to start looking at other ways to tax folks. I think toll roads coming into the city on the major arteries, folks coming into the city. You want to come and visit Toronto? You got to pay a tax. You got to force people into transit. You got to be hard on trades and contractors who do work for the city. The LRT on Eglinton is an absolute disaster. I was just reading an article this weekend in the North York Post about how they still don't have a target date to open this thing up, and they're doing all the testing, and I think one of the components still only at about 85% completion on testing and stuff like that. Like, this is just going to drag on forever and will never, ever seem to be visibility on when this thing is going to open up. And how much more over budget did they go? Can we get answers? Can we find out how much money's been poured into this project? And it just goes on and on and on. But the city announced today that parking tickets, there's going to be an increase to parking tickets. I think over 120 different infractions are going to be increased. And the two most notable ones is if you park in a bike lane or delivery lane, okay, your fine will go up to $200 from $60. And if you park in an EV charging spot and you're not charging, you'll be charged $75. So look up the new infractions by the City of Toronto. There seems to be some excitement about making sure the city moves faster, but we got to get stuff done. We got to be more accountable. These politicians have to be honest with folks, let them know that things are going to get tough, and stop making it seem like things are rosy, okay? They're making things look like flowers, rainbows, and kittens when it's bad, okay? There's nothing good going on in the marketplace right now. Sales are down, inventory's up, things aren't moving, people are struggling. 80 to 100,000 homeowners get a renewal every month, and they're looking at payment shock at renewal time. Budgets are stretched. Folks are struggling. So I caution you, do some budgeting, pull out your bank statements, pull out your credit card statements, print them out. Print them out in hard copy the last 6 months. Go through your spending. Focus on your needs. Get rid of the wants. And here's a tip that I'm getting a lot of positive feedback on. Cancel your credit card. Call your credit card company and let them know that you've lost your card, it's been stolen. They'll issue you a new one, and all your recurring charges are going to have to contact you to reset their charges because you've canceled the card. And then you could decide what you want to continue and what you want to get rid of. Because some of these companies are hard to get a hold of to cancel stuff. So I've said, just call in the credit card company, say you've lost your card. They're going to send you another one with a new number, new security code. And all of a sudden, you're in control as to what recurring charges and subscription fees you want to continue. And a lot of folks don't even realize when you're looking at your statements, they don't even know what some of the charges are. So it's a way to save a few bucks. And for those that are in the variable and floating rates, we've seen the second rate decrease, which is good news. We're now down 50 basis points. And for those to try to put some perspective on what that means, every $100,000 that you carry in mortgage debt or line of credit debt, you're going to save $500. Now that with the additional quarter point decrease, you're going to save $500 a year, which is about $40, $41 a month. If you got a $500,000 mortgage, multiply that $40 by 5, you're probably going to save about $200 a month and $2,500 a year. So, we do anticipate further decreases. It's a matter of how quickly they'll happen. But the reality is we are going to get some relief for those folks carrying revolving debt with those retail prime rates coming down. So hopefully people could rest assured that things are going to get better, but it's going to take a while. We're still going to be grinding sideways as renewals come up. They're still not going to be at the levels that you are at the levels of your expiring contract because they're elevated. So you are going to see a bit of a shock to your payment, but there are other tactics you could take to lower some of your costs, balance your budget, and try to get through the next 12 to 18 months as we grind sideways to get to better days ahead. So on that note, I want to thank everybody for tuning in. Really appreciate all your support and follows. If you have questions, you have any DMs, send them through. We're seeing a lot of folks looking for help on their renewals coming up this fall. So please reach out if you do need some help. We're here to help out and guide you through some options and try to navigate how to maneuver during these crazy times of lowering rates and not being stuck at elevated rates for an extended period of time. So reach out to myself and the team. We're happy to help. And I want to thank you all. Enjoy the weather and the summer. Take care.